Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. I hope everyone is doing well. My name is Bert Salazar, and I am the host to the Bert Salazar Retirement Podcast show here. So this is one that we do every single week. So I'm excited to be here with all of you once again for this week. And today's episode is actually episode number 144. So as you all know, we've been doing this for quite some time. And the title to this episode is, So You're in Retirement, Now What? And this is a question that I get often from the vast majority of my clients, especially those that are getting closer and closer to retirement because, they've been doing it for many, many years. So, they think that it's all about putting money away in their 401ks, IRAs, savings, perhaps even purchasing some real estate properties, making some investments and so forth. But they really have no clue how complex the retirement world truly is, especially when it comes to the distribution of retirement assets and all of the different issues that you're going to have to face as you start taking those retirement assets on an ongoing basis in order to maintain your standard of living. So I always say to my clients when they come to see me for the first time, and even for those that I do reviews with on a quarterly basis, that, getting to retirement is the easy part. Because many times you put everything on autopilot. If you work for an employer, you're making those contributions to your 401ks, to your IRAs, and you do that on a regular basis. And obviously, you don't pay much attention. Perhaps you take a look at your statements once a month, or maybe once every 3 or 4 months, once a year. So it depends on you specifically. But now, when you get to retirement, the rules of engagement are totally going to change for each and every one of you. And the sad part is that the majority of you are not ready and will not be ready unless you actually talk to a retirement strategist and a tax professional that specializes in retirement distribution. So now let's say that you're reaching the retirement summit, perhaps you may be 6 months away, a year away, or you may have just gotten there to your retirement summit. And now you're going to be coming down on the other side of the mountain, which would be your retirement life side of the mountain. So, you kind of get to the top and you look around a little bit, take a look at the beautiful views and so forth. And then you say to yourself, well, I made it, I think. And obviously now a lot of the questions that you had never paid attention to now are going to start to surface and you're going to have to deal with them. So I'm going to cover a number of those, and then I'm going to give you some ideas as to how to safeguard against a financial, what I call a bouncing Betty booby trap. So we'll talk about that in the next few minutes. But one of the first questions that I address with my clients as they come to see me, whether we do it in person or we do it via a Zoom meeting or whatever it may be, is, which retirement assets, and these are questions that you're going to be asking yourself. So which retirement assets do I invade first? Do I invade the taxable assets? Do I invade the tax-deferred assets? Or do I invade the tax-free assets? And there's no right or wrong answer to that, but you have to understand, based on your personal circumstances, what makes the most amount of sense for each and every one of you. And once again, if you haven't taken the time to visit with somebody that understands, retirement distribution, then chances are you're not going to know the answer to that question. Another question that you may be asking yourself at that point in time is, well, I have 2 401ks, I have 4 IRAs because I've been in different employers, and then when I leave, I roll my money to an individual IRA. So I have 2 401ks, I have 4 IRAs, and I have a TSA account. What do I do? Which one of these accounts should I be invading first? Which one of these accounts am I not going to have a choice but to invade when I get to my retirement distribution age? Another question is, well, what is my required minimum distribution age? Is it 70 and a half, or is it age 72? And it all depends on your age. So not only is which retirement assets do I invest first, or which monies am I going to access first, whether it's a 401k, IRAs, or a TSA account if you have one, or what your RMD age is, your required minimum distribution age is. But you're going to have to start doing a lot of math in order to get to the promised land when it comes to your retirement. Another question is, what is the minimum RMD, or required minimum distribution, I must take annually? Well, it depends on your age. For those of you that may not know this, when you get to your required minimum distribution, if you did not turn 70 and a half in 2019, then your new required minimum distribution would be age 72. But if you turn 70 and a half in 2019, then your RMD would be the age of 70 and a half. So you should have taken some money out, or you should be about to take some of that money out immediately at this point in time, if you were in 2020 at that time. Now, the other question that I do get often is, well, Bert, what if I get to age 70 and a half or age 72? And I know I have to start taking money out of my required, under the required minimum distributions out of all my qualified plans, whether it's a 401k, IRA, 403b, any other type of pension. But, what if I decide not to take any required minimum distribution at that point in time because I don't need the money? Well, I think the challenge for you there is that the penalties are going to be incredibly high. Because if you fail to take an RMD in the year that you're supposed to, not only are you going to have to pay taxes on the amount of money that you should have taken, but you did, so you're going to have to pay federal income taxes on that amount, but also the IRS is going to impose a 50% excise tax penalty on that amount that you should have taken, but you did. So let me give you an example. Let's say your required minimum distribution based on the amount of money that you have in your accounts happens to be $20,000 for that given year. And you decide, for whatever the reason may be, not to take that RMD. So if your effective tax rate, or your marginal tax rate, but let's talk about the effective tax rate, let's say is 20%, then you're going to have to pay 20% in taxes on those $20,000 of distribution that you should have taken under the RMD rules, but you didn't. So that would be $4,000 in taxes that you're going to have to pay. But on top of that, there's a 50% excise tax on the entire amount. So all of a sudden, out of $20,000, you're going to have a $10,000 excise penalty plus a $4,000 federal income tax penalty, for a total of $14,000. So out of $20,000 that you should have taken but you didn't out of your retirement accounts, you're going to be left with only $6,000. Now that's going to be very painful, and that's something that you don't want to get to. And if you're close to getting to that area, either talk to your financial professional, talk to your tax preparer or your accountant, or you can always feel free to give me a call along those lines. Now, how do you figure out what your required minimum distribution is? Well, most of the institutions are going to be sending you, based on the amount of money that you have with them, what your RMD, what your minimum RMD is going to be for the year. The problem is that the only RMDs that they're going to be able to send you information on are those RMDs that they have a control over. So in other words, if you happen to have, let's say, an IRA with E-Trade, they're going to send you what the RMD should be for that E-Trade IRA. But if you have IRAs with Fidelity or an insurance company, or you have 401k, they're not going to know, so they're not going to send anything along those lines. Now, the other companies should be able to send it to you, but then at the end of the day, now you're going to have to answer a bunch of questions. If you have multiple IRAs from multiple locations, how can you aggregate and just take one distribution out of those IRAs? And here's why understanding the rules are so important. If you have a 401k and you have 4 IRAs, then your required minimum distributions are going to be based on the account value as of December 31st of the year prior to the year that you need to take your required minimum distribution. So let's say your requirement minimum distribution was in 2020. You have to go back to December 31st of 2019, figure out what was the end of year account value of that 401k, and then apply the formula and take that amount. But then you're going to have to do the same thing for your IRAs. So you're going to have to do that, figure out what the value would be as of December 31st of 2019. Now, one of the beauties of an IRA as compared to a 401k is that if you have 4 different IRAs, because they're like kind in value and quality, the IRS allows you to aggregate all of the RMDs for all of those 4 IRAs, and then you can decide to take it from 1 IRA, from 2 IRA, or from all 4 IRAs equally. So you do have the leverage of saying to yourself, well, if 2 of my IRAs are not doing very well and they've lost money, then I don't want to invade my RMD out of those IRAs because I don't want to create an additional problem. So I'm going to take my RMDs for the 4 IRAs, I'm going to take that money from those 2 accounts that actually gave me a positive return for the year. So there's a lot of calculations, there's a lot of figuring that you must do in order to be able to do your due diligence and understanding, how to navigate the distribution aspect of all your retirement accounts. Now, another question that I often get is, Bert, do I have to take an RMD if I have stock market losses in my retirement accounts? I think I just answered that question because the answer is yes. The IRS doesn't care. So if you're taking money out of an account that has lost value due to a stock market correction, so let's say that your 100,000 dropped 20%, so you're down to 80, but on top of that, now you have to take a required minimum distribution out of that account, and you have no choice but to do so, then that's going to create double jeopardy for you, because not only did your account value go down because of the stock market volatility, but now it's also going down because of the fact that you are being forced to take money out of those accounts. So understanding those rules of engagement are very critical, because in this case, you may never get back to where you were at, because when you compound that 20% loss and you also compound the fact that you're taking money out of that account, you may never get back to breaking even in that account for many, many years to come, if at any time at all. So those are things that are quite important to understand. See, as I said at the very beginning of this podcast, now you get to retirement, so now what? Because there are so many questions that none of you have been able to address for yourself and your families, that if you make the wrong mistake, chances are you and your family are going to pay dearly for the rest of your life. Now, another question that I often get, which it shouldn't be that way, but it happens more often than not, is, Bert, do I have to pay taxes on all my qualified plans at retirement? And the answer is theoretically yes. If you put money into a 401k, an IRA, or 403b, or you got pension money coming in, if the money that went in is pre-tax and the money grew tax deferred, then the entire distribution coming out is going to be fully taxable. Now, there are different ways that you can avoid having to pay taxes on those qualified plan accounts, but obviously, unless you do proper tax planning, chances are you're never going to be able to do that. Now, let's get a little bit into Social Security benefits, which is another big area that I often have to deal with my clients. Now, we do create a Social Security report for all of our clients, to help them determine what would be the optimum time for them to start invading those Social Security benefits. But it's not so much, and it's not only identifying at what age should you and your spouse, if you happen to be married, should you be taking money out of those retirement accounts, but also to figure out the tax implications of those Social Security benefits when they're coming out and they're being deposited into your checking and or savings account. So the question is, do I take Social Security benefits now or later? And the answer is, well, it depends. It depends on your financial circumstances. It also depends on your health. If you have longevity on your side of the ledger, then it may behoove you to wait until age 70 to start taking distributions out of those retirement accounts. Now, always remember that if your FRA, which is your full retirement age, is age 66 for argument's sake, for every year you delay between age 66 and age 70, you actually pick up an extra 8% of benefit value. So over a 4-year period, if you wait until age 70, you're picking up an additional 32%. Now, for those of you that were born in 1960 or later, your full retirement age would be age 67. So therefore, if you wait between 67 and 70, which would be 3 years, then you pick up an additional 24%. Now the question is, well, does it make sense for me to wait, or does it make sense for me to start pulling the money out at either 66 or 67? And once again, it depends on your personal circumstances. Another issue is, how healthy are you? What is the longevity on your family? Have you had any illnesses that would reduce your mortality rate? If you have family members that have lived into their 90s, and you are pretty healthy, and you have brothers and sisters who may be older than you and they're still healthy and living a long life, then it might make sense for you to wait till age 70. But if you have some challenges and you have some health issues, then it may not make sense for you to wait that long. Now, another question is, well, what about your surviving spouse if you happen to go first? Remember, if you're married and you're filing jointly when you pass away, your surviving spouse is going to pick up the higher one of the two Social Security benefits. So if that benefit happens to be yours and you waited until age 70 to start pulling those Social Security benefits out, then your surviving spouse is going to have a higher benefit than if you decided to pull the trigger at age 66 or age 67. So there are a lot of calculations that I do for my clients to determine that, because many of you are going to be leaving money on the table. And then the second issue with the taxation of your Social Security is, will I pay taxes on those benefits? For most of you, the answer is going to be yes, because you haven't done any proper tax planning, and that's something that I encourage each and every one of you to do. If you don't have anyone to do it with, feel free to reach out to me, and I'll be more than happy to do a tax plan and help you navigate through that. But at the end of the day, for most Americans, you're going to be paying taxes. Either 50% of your Social Security benefits are going to be pulled into the tax world, or up to 85% of those benefits are going to be pulled into the tax world as well. So now, if you do it the right way, then you should not pay taxes on your Social Security benefits, because if you have to pay taxes on your Social Security benefits, there's a probability that you're going to run out of money before you run out of life, anywhere between 5 and 8 years sooner than you had expected. Because if you have to pay taxes on those Social Security benefits, that means that there's a hole there that has to be filled. Therefore, you're going to have to take extra distributions out of your retirement accounts in order to plug that hole. So you have to be very careful as to how you do the distribution planning. Now, another big question that I normally get, and that you should be asking yourself, let me just drink a little bit of water, is how long will my income last in retirement? And that also depends. That also depends on what kind of an income do you have. What percentage of your retirement income is guaranteed? If you only have Social Security benefits that are guaranteed, I can pretty much guarantee you that you're going to run out of money before you run out of life, and you may have no choice at the age of 90 to become a Walmart greeter because you don't have any more money and the Social Security benefits are not enough to maintain your standard of living. Another big issue there is doing a provisional income calculation, and that's the type of calculation that I do for my clients in order to figure out for them, if they stay the course, what percentage of their Social Security benefits are going to be taxed in retirement, or if they do it my way, what percentage will actually be taxed. And if we do it the right way, then you should not have to pay taxes on your Social Security benefits, if at all possible. Now, another question that you should be asking yourself, and that I get asked from time to time, is, Bert, have I saved enough money in retirement? And again, the answer depends. It depends on your standard of living. It depends on your healthcare condition, because most Americans, when they reach retirement, they don't factor in the additional cost of healthcare that they're going to have to be able to pay. Yeah, you're going to get Medicare, but you're going to have to pay for Medicare Part B. You're going to have to get a supplement. You're going to have to pay for Medicare Part D, which is for medication and so forth, and many other things. By the way, what if you have a long-term care illness? Well, Medicare does not cover long-term care. So after a few months, you're going to have to be totally dependent. So that means that either you or your spouse or your caretaker is going to have to take more and more money out of your retirement accounts in order to pay the additional cost of maintaining your lifestyle under long-term care conditions, and that's very, very costly. What's the probability that you will run out of money before you run out of life in retirement? For most Americans, the probability is extremely high. It's just maybe shy of the probability of death, which is 100%, or the probability of having a long-term care illness, which is about 70%. So it's going to be between 70% and 100%. So if you don't do your due diligence, and if you don't create guaranteed paychecks in retirement that we'll talk about in the next few minutes, chances are you are going to run out of money before you run out of life. And then the other challenge that many of my clients don't look at and don't consider is, what outside forces can impact your retirement risks. And there are a number of retirement risks that you need to pay attention to. Now, the first one is longevity. You don't know how long you're going to live. Now, Americans are living longer today than ever before. As a matter of fact, when I get a couple age 65 walking into my office or doing a Zoom video conference, when I do planning for their retirement, I do a planning for 3 decades. So I plan between age 65 and age 95. And those 3 decades I call the go-go years, or slow-go years, and the no-go years. Because at the end of the day, you don't want to run out of money before you run out of life. And people are living a lot longer today than ever before, because what used to kill us 30, 40 years ago is no longer killing us. It may leave you disabled, but it's not killing you. So longevity is one of the major nemesis in the impact on your retirement and your retirement risk. Now, withdrawal rate risk. You're taking too much at any point in time. Because of the fact that you don't know how long you're going to live in retirement, you have no clue whether you're taking too much or whether you're taking too little, or you're taking the right amount. If you take too little, then obviously your retirement life is not going to be as predicted. It's not going to be as good as you thought it would be, because you're always going to have to think about tomorrow, and therefore you're going to avoid enjoying today. And always remember that tomorrow is promised to no one, so you have to be able to enjoy today in many different ways. Another outside force that will have an impact on your retirement risk, other than longevity and withdrawal rate risk, is a sequencing of return risk. And we talked a little bit about this one. What if you're taking money out of your retirement accounts and all of a sudden the market crashes and now your account values are down 20, 30%? But you need to continue to take money out whether you're at required minimum distributions or not, because at the end of the day, you need to maintain your standard of living. So you're now taking money out of accounts that are losing value due to stock market volatility, so you're actually compounding the problem. And obviously that will create a big issue. What if the market drops and continues to 2 to 3 years? So you have 2 or 3 consecutive losses, as we have had in the past, 2 or 3 years in a row. What impact is that going to have on your retirement accounts? So that means that you're going to have to continue to take money out. On top of that, if you haven't done any proper tax planning, you're going to have to pay taxes on all those distributions along those lines. So that's going to compound the problem even to a much higher level. Now, inflation risk, meaning that everything is going to cost more in the future. And by the way, inflation, it's what I call a torpedo tax. There are two torpedo taxes that I talk to my clients about, but inflation is one of them, because you never see it coming, but it's here every day. Everything is going to cost more next year and the year after that, and 2 years and 5 years, 10 years, 20 years from now. So you have to make certain that your investment accounts are actually netting you more money than to cover at least a higher amount of return in order to cover the inflation and the inflation risk and even the tax risk from a business perspective. And then other than longevity and withdrawal rate risk and sequencing of returns and inflation risk, there's a fifth risk that most of my clients ever fail to take a look at. And this is what I call the life happens risk. Bad investments, a sick family member that you have to financially help, a long-term care event. Eroding factors are some of the ones that we've discussed, taxes, inflation, stock market volatility, interest rate volatility, propensity to consume, lawsuits. What if you're driving and you get into a car accident and the amount of insurance coverage is not sufficient to cover the damages? They're going to come after you personally, and they're going to have a judgment against you. So those are things that are going to happen in life, and the longer you live in retirement, the higher the probability that some of these things that I have just talked about are going to happen to you. So now that in many different ways I have made you very, very upset about retirement and retirement distribution, and I have probably, if I've done my job correctly, I have probably gotten you to a place in where you're going to start questioning what you've done so far, and if you're readily available for retirement, and if you're readily available to pull the trigger. Then I want to take a little bit of time and kind of walk you to how to safeguard against a financial, what I call a financial bouncing Betty. By the way, a financial bouncing Betty, when I was in the Marine Corps, and I was in the Marine Corps back in the 70s, there was a mine, there was a personnel mine that was called a bouncing Betty. And actually it was created by the Germans during the First and the Second World War. And what would happen is the bouncing Betty has a spring underneath the mine, and what you do is you open a hole in the ground, not too deep, and you put the bouncing Betty there. So as military men are walking down a trail, if one of them happens to step on a bouncing Betty, the minute that you step off, that mine will actually, the spring will hit the mine, and the mine will actually rise 2 to 3 feet, sometimes even higher, depending on the strength of the spring, off the ground, and then explode. And when it does, anything that's around it is going to get hit. So one of the major challenges that Marines had in WW1, World War II, Vietnam, Korea, and so forth, was having to deal with the bouncing Bettys, because if you had a platoon of 10 to 12 men, and all of a sudden, or actually not a platoon, let's say that would be a squad, and one of your troops just happened to step on a mine like that, chances are the entire squad was going to be wiped out. So now how do I equate that to the financial world? Well, a couple of ways that you can, things that you can do to safeguard yourself from a financial bouncing Betty is, number one is to have a Social Security report done for you. Because if you have a Social Security report done for you, it's going to help you make the right decision in the right place for the right reason and at the right time. And so that's one thing that I always recommend to my clients, at least all the clients that engage me for the first time as they're getting closer to retirement. The first thing I do for them is I do a Social Security report, and then we're going to be addressing that report from that point forward. The second thing that I would recommend is a tax planning report, because that's going to help you create a retirement plan tax segmentation for all of your accounts. Now, instead of just having asset allocation on all your investment accounts, now you're also going to have tax segmentation along those lines, which is going to now help you reduce your tax liabilities and reduce your Social Security liabilities in retirement as well from a business standpoint. So normally my Social Security report and my tax planning report goes hand in hand, and it's now a very opportune time to be able to get one done, because the sooner that you can get it done, the sooner the preparation and the planning can start to help you avoid the financial bouncing Betty that I've been talking about. Another thing that would be, and this would be the last point, is that along the way, and when you take a look at the outside forces and longevity, withdrawal rate risk, and sequencing of return, inflation risk, and life happens risk, having a guaranteed paycheck portfolio will offset some of the most challenging risks that you will face in retirement. I deal with a lot of public employees, and all of them, not only do they have Social Security benefits, but they have a guaranteed pension. And because of the fact that I'm a retirement strategist and I've been doing this for 30 years and I'm a tax planner, the vast majority of the clients that I engage are either very close to retirement or in retirement. And one of the things that I can tell you is the following. I have never had a client say to me, Bert, I hate these paychecks, these guaranteed paychecks that are being deposited in my bank account every single month. Can you stop that for me? Because I don't want any more guaranteed money coming in. So if I were to ask you, what percentage of your retirement income would you like to have guaranteed in retirement? If the answer is not 100%, then there's something financially and mentally wrong with you from a business standpoint. Now, it doesn't have to be 100%. It could be 50%, could be 75%, but it should never be 15-20%, because in that way you're leaving everything in your retirement income to chance, and that's not something that you want to do. So having Social Security reports, a tax planning report, and creating within, and we're not throwing the baby out with the bathwater, but in creating within your retirement portfolio, creating guaranteed paychecks in retirement are going to go a long way and are going to provide you with the leverage, the flexibility, and the wherewithal to be able to enjoy and live a successful retirement life, not only for yourself, but also for your beautiful family and for your surviving spouse as well. So I'm hoping that you're enjoying these podcasts that we're doing now. For those of you that may want to reach out to me and kind of pick my brain on many of these topics, because these are critical topics that you should be addressing almost immediately, then feel free to give me a call. You can call me at area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at bertsalazar.com. And always remember that my goal for you and for your family is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, thank you so much for your time today. Stay safe, stay healthy, and I'll talk to you next week. Take care. Bye-bye.